Hi, we are Team 7. This presentation is about uh, Planet Fitness future financial performance and valuation using the DCF model. Planet Fitness is one of the largest fitness club franchises and operations in the United States. It has around 2,700 gyms in the world. It's founded in 1992 and it went public in 2015.
Let's look at the market environment and the Planet Fitness track record. First, of the macro side, the US gym industry is essentially mature with a projected growth rate of only 1.4%. However, inflation is actually creating a massive tailwind called the trade down effect. Consumers are leaving the expensive gym and home fitness option to switch to high value, low price model like a Planet Fitness. Now looking at Planet Fitness historical analysis, while the industry is stagnant, they have delivered a double-digit revenue CAGR after COVID, providing they are capturing market share. Their franchise model is highly efficient, maintaining industry-leading EBITDA margin of around 40%. Most importantly, in 2024, they successfully raised their price from 10 to 15 US dollars, providing they have a strong pricing power even in this economy. In short, a tough macro environment is actually fueling their growth.
Next, I will explain our base case assumptions. On the macro side, we assume a soft landing. Inflation slows down, but prices remain high, putting pressure on consumer spending power. However, we do not expect a sharp increase in unemployment. Consumers move from higher priced gyms to lower cost options like Planet Fitness. Some also switch to free alternatives. As a result, net membership growth slows. Interest rates stay high, making it more expensive for franchisees to borrow money. This slightly slows new club openings. From a business perspective, Planet Fitness continues to focus on its asset-light strategy by selling company-owned stores to franchisees. The 2026 Black Card price increase may cause a short-term rise in cancellations, keeping same-club sales slightly below the 5 to 6% target. Therefore, we assume 130 to 150 net new openings per year, and revenue growth gradually moves toward around 8% over time. Next, I will explain our downside case assumptions. On the macro side, we assume a hard landing, higher unemployment, and lower real wages cause consumers to cut non-essential spending. As a result, the trade-down effect disappears and net membership turns negative. Fitness spending is seen as something people can easily give up. Many shift to free options like outdoor exercise or online workouts. The click to cancel feature also makes it easier to leave, leading to a sharp rise in cancellations. From a business perspective, the 2026 price increase is harder to pass on to customers, and the drop in members is larger than the increase in price per member. At the same time, high interest rates and higher equipment costs reduce franchise investment, significantly slowing new club openings. Finally, stronger competition leads to loss of market share, putting pressure on both revenue and profits.
Moving to our cash flow table, the engine of our valuation, our forecast assumes a 10.5% revenue growth driven by classic card price hike. This generates an after-tax EBIT of roughly 240,000 in our first projection year. To bridge from that profit to actual cash, we make three key adjustments. First, we add back the depreciation. Second, we subtract the capex, which remains high to fund the new growth model. And third, we adjust for working capital, which is a consistent source of cash for this model. By 2029, after-tax EBIT increases to over $380,000 as growth spending normalizes. These resulting cash flows are the fundamental basis for our intrinsic value.
So we calculate the WACC for the in 2024 for the Planet Planet Fitness, and the WACC was around 7.1%. We use like the capital structure for 25.7 in debt and 74.3% in equity. Our cost of equity around 8.4%. Our cost of debt around 4.2, and our tax rate around 27.7%. For the DCF in the for forecast period to 2025 to 2029, we got like a buy signal because our estimate share price was in for 2024 was 115.12, and the actual share price was 99.76% uh, in the basic scenario. So based on what we did and what we expect for the basic scenario, we should buy the stock in 2024.
Keeping in mind the mature market environment in which Planet Fitness operates, uh, we created sensitivity table which shows that Planet Fitness values changes are based upon two critical assumptions. The first one is WACC, which we created a range of 6.1 to 8.1, which according to our base case should be of 7.1%. The second critical assumption is the exit multiple, which we created in a range of 11.5 to 13.5 EBITDA, which according to the base case should be 12.5. So, uh, what we actually learn from this is that even a small change in WACC or exit multiple meaningfully changes the valuation of the company. Most value of around 83 to 84% comes from the terminal value. At our base case, Planet Fitness trades at roughly 10.6 EBITDA. The bottom line is that the Planet Fitness value is sensitive to how we discount the future and what multiples we assign at exit. Our base case reflects realistic assumptions, but investors should be aware of the fact that optimistic or pessimistic scenarios uh, be widened or narrowed down, should widen or narrow down the valuation range considerably.
So our conclusion is buy. Based on our analysis, actual share price in 2024 was $99.76. However, based on our conservative DCF assumption with WACC 17.1% and exit multiple 12.5 times, the estimated share price in 2024 was 115.12 dollars. So it means that there is a gap between estimated and actual price, upside 15.39%. The current stock price does not fully reflect the company's structural competitive advantages and future cash flow generation capabilities. Also, DCS analysis is based on our consultative assumptions, so we concluded that the balance between investment risk and return is attractive. That's all. Thank you.